Tony, I recently was approached by an advisor who was touting the tax advantages of a tax-deferred annuity currently paying 5% interest and how that was the equivalent of earning 6.5% in a taxable CD. This seems too good to be true, is it? Well, it is and it isn't. Now, what I did was, this is an accurate statement. There is something called tax equivalent rates of return. We just grabbed this. You can go on the internet and find these. This came from one insurance company. This is accurate, by the way. We're not picking on anybody, but it notices it says compare taxable, tax deferred, and tax free. Those are the three main ways that you can grow money in terms of how things are going to be taxed. So on the surface, if we look at fully taxable, okay, and we're assuming here we've got $100,000 in each of these accounts. We're trying to think through at the end, I think they use 20 years here or whatever, but at the end of a period of time, how much would each account produce after taxes? So Derek will slide down here. They did a nice job of laying this out. See that future account value after tax? Well, obviously under the fully taxable, assuming a 25% tax bracket, notice the after-tax return is 3.8. So the equivalent of that is going to have to be about 6.5. You see where we're going with that? Because if you're paying taxes on something, you're going to be pulling that away from the return, which affects your overall future value. Then tax deferred, that would be a tax deferred annuity. It has a little bit more, but notice it's going to be taxed to some degree when you go to pull the money out, which I'm going to share with that how that works in a minute. And then the ultimate is what we call tax-free. Now, this tax-free, you've got to watch a little bit because, yeah, you could go get a muni bond that's tax-free or something like that, but a lot of times they're not paying the same tax rate. This is just a calculator. Then someone might say, yeah, that's why I want a Roth IRA, Tony. I want that Roth because it's completely tax-free, and that would obviously be more than anything I could ever have. Well, in a minute, we're going to find that's not accurate either because you have to calculate the lost opportunity cost on the taxes before it goes in the Roth. So what I thought I would do is just kind of mosey over here to the whiteboard. Okay, now this is going to be very interesting. We're going to compare tax deferred versus taxable, and under the same circumstances, we're acting like we're in a laboratory here. Given the same circumstances, is there any tax savings to deferring taxes now versus paying them today? So let's take this example. The present value of our calculation is $200,000. That's what somebody has today, all right? We're imagining that in each instance, tax deferred and taxable, each category is going to earn 5%. We're going to wait to see in 20 years what this would be left if we just compound the interest, and we're going to assume each person is in a 30% tax bracket. So let's imagine you have the present value here of each of these. We're starting off out of the gates at the same amount, $200,000 each. At 5% interest, you would think, right, in the tax deferred, you'd have much more than the taxable. Well, let's take a bank CD. Most people don't literally pull out money to pay the tax like our last chart showed. That's not how they do that. Most people let the bank CD interest compound, and when they get a 1099 at the end of the year for the interest, they just pay it out of pocket, all right? But the account continues to compound. In fact, based on this, I'll round it off a little bit. Ironically, in 20 years, and this should be obvious, they both earn 5%, so they're both worth, the future value of each of these is $530,000. But you're saying, Tony, but what are all the tax savings? Well, it doesn't matter. If we go out here and we compound this out, if you were to liquidate a tax-deferred annuity, all of that gain is taxed as ordinary income, which means you're going to have to pay about $99,000 in taxes. You with me? So we let the accumulation of the annuity defer. We yank it all out, assuming a 30% bracket, we're going to owe $99,000 in taxes. Well, the CD, there would be no taxes. However, we had to pay taxes each year, right? Because that interest hit our tax return, had to pay the tax. If you add all that tax up, ironically, it's the same amount of taxes. So you say, but Tony, this doesn't make any sense. This tax equivalent thing and saving all this money, I don't see any tax savings. Well, the tax savings is not what you're saving. What you're saving is something called opportunity cost. You see, this is what most people don't understand. You have to understand that everything comes with a cost. The real cost is when you don't take the money out of your IRA or, out of your CD to pay the tax, you got to take it out of pocket. So based on 5%, that means your opportunity cost is roughly of this $52,000, which is a real cost. So basically, It was the taxes you had to pay now from another source at 5% that cost you money. But you know what? What could happen is, what if this went to 40% and you've already paid the taxes? You may come out ahead just paying the taxes now. You're hoping with tax deferred that either you have a strategy in place to minimize those taxes, or the idea is you're in a lower bracket down the road to effectively save taxes and, of course, even more lost opportunity cost.
Thanks for watching. We hope you enjoyed that video. If you'd like, check out these other clips. And be sure to hit that like button and that subscribe button for more videos.